Hi everyone, Alex from Summerhill, just with another quick video update. There have been several tax and superannuation changes recently announced, coming into effect from 1 July 2024. In this video, we just wanted to cover off on some of those changes and how they may impact you. We will obviously contact you directly or discuss the changes in your planning meeting if they do impact you, along with the steps that you should take in order to prepare and take advantage of them. Starting with the changes to personal tax rates, as I'm sure many of you are aware, the government's revised Stage 3 tax cuts have now passed. Refer to the attachment in the email for further details about the specific changes compared to the tax rates applicable this financial year. We've also included a table outlining how much tax one might save based on the differing taxable incomes. The changes will result in higher tax payable for those with incomes above $140,000 and lower tax payable for those with incomes below $140,000 compared to the previous legislated Stage 3 tax cuts. However, most will see their tax reducing compared to the tax rates applicable this financial year. So, what should we be thinking about as a result of these changes? As I said, the changes will result in most seeing an increase in their after-tax income, so you may wish to consider using those tax savings to build wealth. For example, the tax savings may provide you with more scope for making additional tax-deductible superannuation contributions, which may create further personal income tax savings. Alternatively, using the tax savings for reducing non-deductible debt or to invest personally or through a trust may be appropriate. Another important factor to consider will be the timing of your superannuation contributions. For example, if your marginal tax rate is going to decline in the 2024-25 financial year, you may gain a greater benefit by making a personal deductible contribution before 30 June. Conversely, if your marginal tax rate won't change, the tax benefit from making a personal deductible contribution will be the same. If you're thinking about selling assets, it will be important to consider the timing. If your marginal tax rate is going to be lower in the 2025 financial year, you may pay less capital gains tax by selling that asset after 1 July this year. But before you decide to defer any asset sale, it will be important to also consider market risk. The value of the asset could decline and offset or eliminate any tax benefit from selling the asset next financial year, and holding costs, which for real estate, that might include rates, insurances, interest payments, etc. Another consideration is reviewing the timing of your tax-deductible expenses, including prepaid expenses. It will be important to consider whether the benefit of a tax deduction for eligible expenses is more valuable in the current financial year or from 1 July 2024. This will depend on your assessable income and the value of the deduction. Examples of deductible expenses that may be prepaid include premiums on income protection policies held outside of super, interest on a fixed rate investment loan, expenses for a rental property, financial advice fees, and work-related subscriptions. Another consideration is for those who may receive an employment termination payment. So if you are planning to retire or receive a redundancy package soon, you may wish to consider the impact of the tax changes. In some cases, it may be possible to time the termination of employment so that amounts received upon termination are received next financial year. Traditionally, this has been beneficial when the person's income is expected to be lower in the following financial year, say for example due to retirement, or in this case as well due to the tax changes. Moving on to superannuation, transfer balance and contribution caps. From 1 July 2024, the annual concessional pre-tax contribution cap will increase from $27,500 to $30,000, and the annual non-concessional after-tax contribution cap will increase from $110,000 to $120,000. These changes can impact strategies for making contributions before and after 1 July. The appropriate timing of contributions will depend on a number of factors, such as your age and birth date, taxable income, total super balance, both at 30 June 2023 and 30 June 2024, contribution cap space, and obviously surplus cash flow. Opportunities of these changes can include for those who are in their final financial year of contribution eligibility, whether that be due to their age or total superannuation balance, can maximise their available after-tax contributions by triggering the bring forward rule before 30 June. For others, delaying the triggering of the bring forward rule until after 1 July 2024 will generally enable you to maximise your after-tax contributions. Clients with less than 500,000 in their superannuation on 30 June 2023 and unused concessional contributions from the last 5 financial years may be eligible to make up catch-up concessional contributions. There could be 2 benefits of accessing unused carry-forward concessional contributions before 30 June 2024. These include unused cap amounts from the 2019 financial year will be lost if not used by 30 June 2024, and changes to personal tax rates from 1 July may result in it being more favourable for you to have and maximise the tax deductions this financial year rather than next. The general transfer balance cap is expected to remain at 1.9 million on 1 July 2024, but this is yet to be formally confirmed by the ATO. The transfer balance cap is the amount you can add from your superannuation to a tax-free income stream pension, and it's indexed in increments of $100,000. Although the general transfer balance cap is going to be unchanged on 1 July 2024, the current inflationary environment makes indexation from 1.9 million to 2 million very likely from July 2025 based on the latest CPI figure. So if you're eligible, but you don't yet require a regular income stream from your superannuation, it could be beneficial to delay the commencement of an income stream until July 2025 to access the potentially higher cap. Moving on to Division 296 tax. As a reminder, this is the proposed additional tax applicable on superannuation investment earnings for those with a total super balance above 3 mil. This is still currently before Parliament, and there's an expectation that the government wants to have it passed by the end of the financial year. As you know, we do not make changes to financial strategies based on proposed changes from the government. If passed, it doesn't take effect until 1 July 2025. So there will still be time to take action to restructure one's affairs to potentially reduce the impact of the change. There will be no further progress on the bill until the committee releases a report on this measure on 19 of April. We will continue to monitor developments and will reach out to those personally who may be impacted by the change. So that's it from us for today. If you have any comments or queries, please don't hesitate to get in touch. Thanks.